Have you ever wondered how much you can borrow for a mortgage based on how much you make? Well, good news for you, that's exactly what we're going to talk about in this video. We're going to go over the three best ways to determine how much you're qualified to borrow for a mortgage based on your income. Hey guys, what's going on? My name is Jarrett White. I'm a mortgage broker with White Ridge Mortgage here in British Columbia, Canada. If you wouldn't mind, please hit that like button, subscribe to the channel, and ring the bell to be notified. It would go a long way in helping me get this video in front of more people just like yourself. So without further ado, let's get on into it. So there's really three different ways you can go about determining how much you can borrow for a mortgage based on your income. I'm going to go through these three different ways, starting with the least accurate and moving all the way up to the absolute most accurate way to determine this amount. So make sure you stay to the end because even number 2 and 3 are both very accurate ways to determine how much you're actually qualified to borrow. So the first way would be using the rule of 4, and this is pretty standard across the board, and it's important to understand that this is not 100% accurate because there's a lot of people that do have debts, maybe property taxes are higher, strata fees are higher, so there are things that could influence how much you can borrow. Even something as simple as the interest rates being higher or lower could change this, but the general rule of thumb is you can multiply your gross income, your before tax income, by 4, and that's how much you can borrow for a mortgage. And then of course you would add your down payment on top of that. So unfortunately, if you are self-employed, you actually have to use a 2-year average of your net income, and that's the amount we can include on the file, and that's the amount that you would be multiplying by 4. This is a great method if you're really just trying to get a very rough idea. However, if you actually do plan to buy a home, it is a terrible way to determine what your borrowing power is, and I highly recommend you at least do number 2, but more so, I recommend you do number 3, and I'll get into that in a sec. Number 2 would be having to use an online mortgage calculator, and I'm gonna go through that in just a sec. I got mine right here, and I'm gonna put a link in the description if you want to download it. It is 100% free, and it is honestly a great tool to use to determine your borrowing power. You can also get pre-qualified directly within the app. It's important to keep in mind that pre-qualified and pre-approved are two separate things, but getting pre-qualified is still a great first step. And there's a bunch of other tools on there that are really good as well. Okay, so I'm gonna go grab my calculator right here, and there is a required income setting on it that you can use. So when you get into the app, you're gonna tap into the required income setting, and we're basically gonna go through this together. So there is a setting on here: mortgage amount, gross annual income, property taxes, condo fees, heat, monthly debts, rate, okay, and then amortization. So we're gonna go through based on a couple different income amounts to see how much of a mortgage you'd be able to borrow. So first we gotta account for a couple different things. When you're getting a mortgage, we have to include property taxes and condo fees. So I'm gonna include, let's say, $2,000 a year in property tax. Now that is quite low depending on what you're trying to get, but if it's a condo, could be reasonable. Now condo fees, standard condo fees around 350 bucks. So I'll include that. Heat, maybe around 100 bucks. And let's just say for this scenario, you have 0 monthly debts. You don't have a car payment, you don't have any line of credits, you don't have any credit cards. Interest rates right now, they're around 5%. And let's say you're getting a 25-year amortization. So let's start off with $50,000 of income. Okay, so $50,000 of income, we want this GDS and TDS ratio to line up below 39%. So you're probably looking right at the 170 mark. So just under 170,000 is what you would actually be qualified to borrow with $50,000 of income if you had these other expenses added in. Now, if we increase that to about $70,000, you'll notice that the GDS and the TDS ratio at the top go down quite a bit to 27%. That means we're allowed to increase this mortgage amount. So as we increase this mortgage amount, like I said, the max with most major banks in Canada is a 39% GDS ratio and a 44% TDS ratio. And to understand what the difference is, a GDS ratio is how much your mortgage payment is taking up of your total income. And then the TDS ratio is how much your mortgage payment plus all your other debts combined is taking up your income. That's why in this scenario, they are exactly the same. But you'll notice if I do add some monthly debts, I'm gonna go in here and add a credit card, let's say CIBC, and you have a $50,000 balance on it, just so I can show you how much of a difference it actually makes. Now you'll notice the TDS ratio is quite a bit higher. So I'm going to go in there and remove that debt so we can go back to our scenario. Okay, so let's base this on $90,000 of annual income. So we can now increase this mortgage amount up to about $360,000. And if we go one step higher, $110,000, you can increase that mortgage amount up to about $450,000. And this isn't a 100% accurate way to assess it as well, because the standard guidelines with banks are 39% GDS and 44% TDS. However, we can sometimes stretch that, and in most cases, banks will actually allow you to go up to 44% on both the GDS and the TDS. So there are ways that we can increase how much you can borrow, but that calculator is honestly a great tool to get a rough idea, because honestly, it will be more conservative if anything. Therefore, you're playing it a bit more safe going off of those numbers than what we can actually end up qualifying you for. But that does lead me to number 3, and this is the best way to determine how much you can borrow and the most recommended way if you actually plan to buy a home. I recommend that no one buys a home unless they do this first, and that is getting pre-approved by a mortgage broker, not by the bank, by a mortgage broker. Because we have access to 50 plus lenders, and because of that, each bank has their own set of policies, and it's important to find a broker that can actually match those banks up with your unique situation. Now, the reason why getting pre-approved is so much more important than the other two options is because with a pre-approval, the broker is actually going to be intaking documents from you, reviewing your income, and determining exactly how much we can include. The biggest issue with those calculators and the rule of 4 is that you don't really know how much income we're actually allowed to include. Just because you make $100,000 a year doesn't actually mean we can include $100,000 a year. It might mean we can include $100,000, but not in every case. Therefore, it's important to have a mortgage broker review all your income documents and make sure that we're accounting for property taxes, strata fees, all your debts, and basing it off of individual lenders that have policies that might benefit your situation. Now, to give you an example, I did a pre-approval for a firefighter, I think it was about 8 to 12 months ago, and basically his situation, he was working salary, but he also worked a ton of overtime. But he only recently started working overtime. So when we're including overtime, most lenders want us to include a 2-year average of your income if we want to include that overtime. If we don't want to include it, we can just take your salary. However, I found a lender that allowed us to do a 24-month average instead of a 2-year average of his tax returns. And what that meant is we could actually include 5 more months of him working overtime, because previously, if we were just using his tax returns, he wasn't working much overtime at that point. And what this meant is we could actually include $20,000 more of income, which increased his borrowing power by about $80,000. And if he didn't come talk to me and actually get pre-approved, there is no way that the calculator or the rule of 4 would have gave him a number even close to that and also been accurate at the same time. You also just want to make sure that you're shopping within your budget. There's no point looking at homes if you actually don't know if what you qualify for is true. So if you're interested in getting pre-approved, I just wanted to quickly go over how the process works. So the process starts out with a simple phone call. It's about 5 to 10 minutes and you don't need to prepare anything. This phone call is just for me to get a rough idea of your situation. I'll ask you questions about your employment. I'll ask you questions about your debts. I'll ask you questions about your debts. And then this is where I'm going to determine if you're actually in a decent position to move forward in the process. If not, well, I'll try and supply you with some resources that can help you get into a better position. But if you are, then the next step is filling out an online application, which I will send to you. Once that application is complete, then I'll send you a list of documents that I'm going to need. All you have to do is gather those documents and then you are all done. The rest is up to me. I'm basically going to review your file and send out a big report over email with a video going through all of it so you understand. And then if you want to go through it together, that is something that I offer. You simply just book a call at the bottom of that report and we go through it together. And then once you're done that, you are on your way to looking at homes. And it's honestly a very, very straightforward process. And I encourage all you guys to do it if you actually plan to buy a home in the near future. A couple misconceptions is your pre-approval does not expire. The only thing that would expire is if we were to hold an interest rate with a bank that lasts 4 months. However, the assessment on how much you can borrow stays the same pretty much forever as long as you're not changing your employment situation or unless there's not a drastic change in interest rates. However, we are with high interest rates right now, so if they do come down, that only puts you in a better position, not a worse position. So there you have it. Those are kind of the three ways you can determine how much you're qualified to borrow. Like I said, I put a link in the description for that online mortgage calculator. It's 100% free. I encourage you to download it, even though it is a rough idea. Like I said, you could do a pre-qualification in there, which is also a great tool prior to getting pre-approved by a mortgage broker. But if you're ready to go start looking at homes, getting pre-approved by a mortgage broker is 100% the best way, and it's honestly not much work. Thanks a lot, guys. I hope you found value in this video. If you wouldn't mind, please hit that like button, subscribe to the channel, and ring the bell to be notified, and I'll catch you on the next one. Thanks.